Center of Kentucky, a program funded by the Small Business Administration and hosted by Community Ventures. More information about us can be found on our website, www.wbckentucky.org, and please like and follow us on Facebook. If you can, please mute your phones right now. That way, the background noise won't be heard. Everybody? Okay, the mission of the Women's Business Center of Kentucky is to empower, support, encourage, and equip women for success in business through workshops, counseling sessions, and networking opportunities, like our monthly fourth Friday Strong Talk Strong Women Roundtable. For the men out there, we also work with men entrepreneurs. My name is Phyllis Alcorn. I'm the director of the Women's Business Center of Kentucky. Assisting me today are Elaine Goldstein in the Louisville office. Elaine will be handling our questions and managing the Zoom waiting room. Also working with the Women's Business Center are Pam Russell in the Campbellsville office, Mark Johnson, who works with our artists, and Sean Burns, who covers our Millersburg office. Jonah Brown and Monica Sanders are our marketing team. I see the little screen is back now. A few housekeeping items before we get started. Just like we've done for the past 2 weeks, we will address all questions at the end of the presentation through the chat box. Type in your question where indicated and send it to A. Goldstein. That will go to Elaine. She and I will address your questions at the end. I'm trying to deal with this little box and it's not cooperating.
Phyllis, do you have a window open? Another window open on top of this one?
I have the window of the people. It's just the people. I can minimize that maybe. Is that it?
Try and see, because I've been trying to look up why it's showing, and it's saying that there may be another window on top of this shared one that's open or something. I don't know if that's the one that they're talking about.
Okay. Move this window away. Okay.
Maybe not. I'm trying to troubleshoot.
I'm not sure. Because I saw something that said about floating controls, and okay, I'm gonna just fly on ahead, I think. Okay. If you find anything, let me know. If this is distracting, let me see. I'm gonna go back to that. So can you all see it at all? Because I minimize that. I just have a really busy desktop.
Latoya says that it might be that you have multiple tabs open on the same browser.
Okay. I'll leave. I'll post my Okay. Got rid of that. Okay. I got rid of email, so maybe that was it. I need all the help I can get. Okay. All right. Thank you all. Okay. Takes a village to get Phyllis together. We talked about that. Last week I sent out week 2's homework booklet. If you'd like feedback from Elaine or myself, please use the chat box or send us an email and we can schedule some one-on-one time to discuss your plans and answer any questions you might have. Throughout these past 2 sessions, we've been talking about and going over the steps to start and grow your business, paying particular attention to helping you write a business plan that will document your processes and the steps to start and manage your business so that you can make money, because that's the objective, right? Despite an unusual occurrence like this pandemic we're in the middle of. As a brief summary, we talked about the business model concept, to focus your energy and attention on how you will make money. This concept highlights your revenue streams while focusing on the value you will bring to your target market. We talked about ways to market your products or services with the messages that will appeal to your target market with the direct intention and purpose of creating customers who will become repeat buyers and who will feel compelled to spread the word about you so that your market base will continue to increase and grow. We've continued to talk about the impact of this quarantine on small businesses, especially in how it has really changed our lifestyles and how businesses do business. As a result of this change in the way we do business, many have struggled to remain open as they have been unable to adjust to the forced changes in their processes to accommodate the mandated slow or shutdowns. We even looked at an example last week of the restaurant industry, and we plugged in numbers to truly understand the impact to their bottom line as a result of being forced to shrink their inside seating capacity from 100% to 25%. We talked about the importance of having a detailed business plan to help you better manage and be more prepared for situations like that one. We also said this is important, but not perfect as far as writing a business plan, but it will help you to get a better starting point for your business and help you prepare better to adjust, especially if your plan includes plan B, plan C, plan D, all the way to as far as you need to have it. So business plan is where you describe your products or services. It's where you talk about your experience, your knowledge, and your qualifications. It's where you identify things like your goals for your business, why your business exists, who your target market is, why people will buy from you, who your competitors are, what your industry looks like, and exactly how you plan to make money. It's where you talk about how you might handle unusual circumstances should they come up, and how you can best continue to serve your target market. Then last week we talked about your marketing plan section, which is where you would include details about how you plan to get your customers to buy from you. Your marketing plan will include details about your products and or your services, your marketing strategy, your pricing strategy, how you plan to promote and advertise your business, and even where you plan to locate. We talked about how one of the most beneficial marketing efforts will come from you and from the people you meet in various places. This brought us to our 15-second elevator pitch or call to action message mapping strategy, where you deliver a clear, defining statement about your business by offering one main point to summarize what you do. We rounded out our marketing conversation highlighting the importance of good customer service and how much that impacts your revenues. With good customer service, you encourage your customers to keep coming back to buy from you. And then they will tell others, hopefully they will tell others about your great customer service and what you have to offer. So basically, good service never goes out of style. I can't stress enough the importance of a marketing plan for your business plan. Please spend a lot of time and put a lot of thought into methods you will use to attract and attain your customer base. Repeat customers equal increased revenues. From there, we spend time on our operational plan, which is where you describe your processes, your hours of operation, what holidays you will observe, and what your facility will look like. We looked at your SWOT analysis, looking at your internal operations, where you analyze your location, your management expertise, your employees, your products and services from an operational standpoint. Then we looked at your opportunities and threats from an external operations perspective, considering strategic alliances, your competitors, price wars, and even pandemics fall under this category. We've covered a lot of territory in these past 2 weeks. Today's session will highlight human resources issues, such as hiring practices, labor market, insurance, record keeping. After that, we will look at financials and look at various ways to measure your revenues to see how well you're doing for those already in business and to project or forecast how well you might be doing going forward for those who plan to start a business. So before you hire employees, give thought to what needs to get done in your business, how often it needs to get done, and the amount of expertise that is needed in order to complete that function. Also, develop a policies and procedures manual to outline standards, rules, and regulations for your workplace. So once you determine you do need help in a particular area And the only way to satisfy this help is to hire somebody, come up with a plan to define exactly what you need them to do. We need somebody full-time to help to satisfy the work that needs to get done. Can what you need done be accomplished on a part-time basis? Is it something you need permanently, or will hiring a temporary employee do? The best way to do this, the best way to actually define what needs to get done is to write a job description, one that clearly defines a person's job title, the daily job functions and responsibilities, the benefits that you'll offer and the compensation package you'll offer, and also a description that outlines the hours that employee would work and who they would report to. Writing out a specific job description eliminates guesswork about what your employees will do on a daily basis. This also saves you money in the long run, as it will make the best use of your money. Something else you might want to take into consideration is what is going on with the local labor market. What is the unemployment rate in your area? What is the unemployment rate nationwide? These statistics govern the availability of skilled workers. It also governs the number of folks who can afford to buy from you. Because if people are not employed, they're not making money. That means they don't have money to spend, extra money to spend. If unemployment rates are high, that means a lot of folks are without jobs and maybe without financial resources to freely buy from you. If unemployment rates are low, that means folks are gainfully employed and should have money available to spend with you. This pandemic hit us in March. In April, the unemployment rate nationwide was 14.7%. In Kentucky, the unemployment rate in April was 16.7%, which is pretty high, showing 339,737 folks were unemployed. That's a lot of people. In June, the national employment rate dropped from 14.7% to 11.1%. Kentucky's unemployment rate dropped to 4.3%, and that showed 82,714 folks unemployed. So employment in Kentucky is looking a lot better than nationwide, but it's still not great. So other considerations to look at when your hiring practices would be, what is the going wage in your area for the level of expertise you're seeking? What benefits are typically offered for this level of expertise? All these items become a factor. It helps you become more competitive as well, especially when unemployment rates are really low or the level of expertise is highly specialized or in high demand. Low unemployment rates signal jobs are plentiful, and employees might have more choices of where to work. That factor is definitely industry specific and area specific as well. You also want to give thought to how you will advertise availability to find the most qualified individuals to fill your vacant positions. If it is important that you have someone who's college educated, will you contact college career centers to help you fill those vacancies? If college education is not an issue, but skilled labor is, will you contact an employment or temporary agency? Just where will you advertise to fill your job vacancies? Those are things to think about. Temporary employees are a great option when you don't need or can't afford regular or full-time help. With temporary employees, you won't have to spend money on benefits or spend time and resources screening them. You only use them for as long as you need them and for as long as they work out for you. If they don't turn out to be a good fit for you or your company, then you simply call the agency back and you say, you know what, this person didn't work out, could you send somebody else with similar qualifications and experience? That's as simple as it is, right? As a business owner, you definitely want to keep a grasp on the unemployment rate in your area and in your country, in the country. Hiring your first employee as a new business owner is both an exciting and frightening experience. You have a person relying on you to pay them so that they can now provide for their family while you are now balancing the cash flow needs of your business. There's also a lot of paperwork and laws to comply with. Here are 8 steps a business will need to take into consideration when hiring their first employee in Kentucky. Step 1, you want to make sure you register as an employer. by obtaining your EIN number, Employer Identification Number. Actually, this is now a required step when starting a business in general. So that you are prompted to do that. At one time, you could start a business and use your social security number as a reference. But now, most states are requiring that you get an EIN number. But if you haven't gotten one and you're now ready to hire an employee, then you definitely have to get an EIN number. Step 2, you want to verify that your employee that you're getting ready to hire is eligible to actually work in the United States. Within 3 days of hire, employers must complete an I-9 form, Employee Eligibility Verification Form. This form is used to confirm citizenship. Employees fill this out. This form is used to confirm citizenship and eligibility to work in the United States. The employee completes Section 1 by the first day of working, and the employer completes Section 2 by the end of the 3rd business day after the employee starts on the job. Although everyone must fill out this I-9 form, you as the employer are not required to send this form to the federal government. You are, however, required to keep this form on file for 3 years after the date of hire or 1 year after the date the employee's employment is terminated, whichever is later. There's also an online electronic verification which is available to check your employee eligibility, and that's called E-Verify. So again, they're trying to make this a little simpler, I guess, not as intense. Step 3 is to set up records to withhold taxes for your employees. And this is where you basically are setting up your records to withhold. Set that right. Records to withhold taxes for your employees. The IRS states that you must keep records of employment taxes for at least 4 years. Every employee must provide an employer with a signed withholding allowance certificate or Form W-4. We've all heard about the W-4 form. This determines how much federal income tax will be withheld from the employee's paycheck. And the employer keeps this on file as well. Okay, step 4 is new hire reporting when you register with the Kentucky's new hire reporting program. All employers are required to report new hires and rehires to the Kentucky New Hire Reporting Center within 20 days of their hire or rehire date. Step 5 is register to pay payroll taxes. And those taxes would be federal income tax withholding, state income tax withholding, Social Security and Medicare, as well as unemployment insurance. Because this is quite rigorous and a lot to keep up with, there are companies out there to help you with the paperwork to ensure the filings are done correctly. Because we'll have deadlines for filing this information, and it's a lot to keep up with. Basically, people do hire companies to take care of this, especially small companies. Okay, step 6, obtain workers' compensation insurance. All businesses with employees, even a single part-time employee, are required to carry workers' compensation insurance coverage through a commercial carrier or through the state's workers' compensation insurance program to cover medical costs if employees are injured on the job. Workers' compensation insurance is administered through the Kentucky Labor Cabinet. Step 7, you want to post labor law posters and required notices. Kentucky businesses must display federal and state of Kentucky labor law posters where they can be easily seen by employees. These posters inform employees of their rights and employer responsibilities under labor laws, and they help you maintain a healthy and fair workplace. And that's pretty important. And then step 8, simply stay up to date and get organized. You want to definitely maintain a healthy and fair workplace and keep your employees informed about company policies. So as you can see, there's a lot involved with hiring employees. But what if you've determined what you really need is someone to build your company a specialized computer system, one that can track specific information about your customer base? You've looked and nothing is already out there that does this. What will you do? Well, basically, in this case, you would hire an independent contractor. The independent contractors are those who are specialized and they are very knowledgeable in a specific area. and they are hired out to do certain jobs, specific jobs. The main difference between an employee and a contractor is that the employer has control over the activities of the employee, but the contractor does his or her work independently. The employee has a specified salary or wage and is bound by an employment contract, whether written, express, or implied. The contractor sets their own rate. They offer you their own terms in a contract. You, as the business owner, accept or reject this rate, contract, or terms. And because independent contractors can be paid on a per job basis rather than part of an ongoing salary with benefits, independent contractors can be as much as 30% cheaper to hire than employees. So once you've decided to hire an independent contractor, the first step you want to do is to have them complete a W-9, which is a request for taxpayer identification number and certification. This form can be used to request the correct name and tax ID number of that worker. The W-9 should be kept in your files for 4 years for future reference in case the worker or the IRS has questions later. In addition, if you paid somebody who's not an employee $600 or more for services done during the year, a Form 1099 MISC needs to be completed, and a copy of that must be provided to the independent contractor by January 31st. The business owner must also send a copy of this form to the IRS by February 28th. So it's critical that business owners clearly distinguish between who is an employee and who is an independent contractor. It all comes down to withholding the proper taxes. An employer must withhold income taxes and pay Social Security, medical taxes, and unemployment tax on wages paid to an employee. Whereas businesses normally do not have to withhold or pay any taxes on payments to independent contractors, because the earnings of a person working as an independent contractor are subject to self-employment tax. So the general rule is that an individual is an independent contractor if the person paying them has the right to control or direct only the result of the work, not what will be done and how it will be done. Okay, so again, the general rule as an independent contractor, an individual is an independent contractor if the person paying them can control only the result of what was done, the result of the work done, and not what will be done, nor how it's done, okay? And there are other ways the IRS makes this determination as well. For example, there are some behaviors they look for. They look for a worker as an employee when the business has the right to direct and control the work performed by the worker, which we just talked about a second or two ago. They look at the type of instructions given, such as when and where to work, what tools to use, where to purchase supplies and services. They look at the degree of instruction given. More detailed instructions may indicate that the worker is actually an employee. Because again, the independent contractor is assumed to be someone who is knowledgeable, someone who is knowledgeable in a specific area. So they don't need to be told, details of how to get the job done. Also, evaluation systems are set up for employees to measure details of how the work is done. And that definitely is a key to being an employee, right? And also training a worker on how to do the job is typically indication of an actual employee. There are financial controls in place as well. For example, does the business have the right to direct or control the financial and business aspect of the worker's job? Okay, those are just things they look at there. There are relationship things they look at as well. The IRS is actually targeting these things. They're looking at ways that your company is distinguishing between, or to tell if your company is distinguishing between an employee versus an independent contractor. So they look at things like this to determine yes or no, okay? And bottom line is there are consequences for misclassifying an employee. Classifying an employee as an independent contractor with no reasonable basis for doing so makes employers liable, okay? The employers become liable if they do that for employment taxes. So again, classifying an employee as an independent contractor with no reasonable basis makes the employer liable for employment taxes. I don't know about you, but I certainly wouldn't want to pay an additional tax. Since it takes a team to run a successful business, and you can't possibly know and do everything by yourself, have a list of folks available that you can consult with if needed. For example, Community Ventures has business specialists who will work with you. Women's Business Center, we're here to work with you as well. There's SCORE, there's Small Business Development Center, just to name a few. And the SBDC is Small Business Development Center. So we're all available to offer one-on-one counseling services at no cost to you, the business owner. In addition, look for help from insurance agents, accountants, attorneys, or even bankers, professionals you work with on a regular basis who can offer advice, but especially those that you have a relationship with. Okay, so let's take a look at business insurance. Insurance is a risk management tool. Insurance minimizes your costs should something go wrong or not as expected. So listed here are several types of insurance. Of the ones listed, as a business owner, please consult with your insurance agent to determine which types are the best for you and for your business to have. To consider the best rates, work with an insurance agent you currently have a relationship with. Perhaps you could bundle your insurance and get a package deal. For certain types of businesses, being bonded is necessary along with being insured. For those businesses, being bonded will appeal to their target market. Being bonded provides extra protection and coverage for a job not completed to satisfaction, for items that get damaged or broken as the service is being provided, or if items are stolen or become missing, the service is being provided. For example, a cleaning business that is bonded will be more appealing than one that is not bonded. For the bonded cleaning business, a vase gets broken while cleaning is being done. You file a report, you as a business owner file a report, listing the vase as and its value. The client is reimbursed for the broken vase. For the unbonded cleaning business, when the vase gets broken, they will need to pay, the business owner will need to pay for this vase out of their pocket, and they would also run the risk of not being hired back by this client and the likely risk of not being referred to other people that the client might know. So always think about ways you as a business owner can protect yourself in your business. As a business owner, you will need to keep good records. As you could tell by the talk we just had about hiring employees. It is therefore your job to figure out the best system for you to keep records of sales and employees and expenses and clients, just to name a few of the things you'll need to keep records of. Figure out the best method for you for organizing your records and then stick to that system. If you find something better along the way, make an adjustment, transition your current files and records and stick to that. You keep records to monitor the progress of your business, to prepare financial statements, to track sales and expenses, to keep track of when bills are due, to keep track of deductible expenses and equipment, to prepare tax returns, to keep track of purchases made, for payroll taxes, to track employee data, to track when equipment needs to be replaced and when the warranty runs out, and much more. Your business equipment and inventory are things of value. They are assets that you purchase for your business. You will want to keep records of these purchases for sure. Be careful when paying cash for business expenses as well. It's hard to keep accurate records of cash transactions. Business failures time and again have been blamed on improper accounting of records and financials. So you want to definitely make sure that you keep good records and you keep a good set of books. Keep documentation on your equipment and any warranties that they may have as well. So here's a quote from Bob Willis, who formerly owned a bookstore called Book News. Our biggest mistake, he said, was that we didn't keep a regular set of books. Half of our records were on scraps of paper and receipts. We didn't know whether accounts were paid or not. We thought we were making a profit, but a good set of books would have shown us the truth. We were going broke. Had I realized that, I could have taken steps to change things. So if you are a one-person operation, start with something simple, then grow from there. Be sure you set up a separate checking account. This separates your personal expenses and transactions from your business transactions. Along with accounting systems, there's also software out there that can help you keep track of your financials. If you enjoy keeping manual records, invoices, or receipt books and ledgers, do what works best for you. Again, figure out what you need and what will work best for you and your business, and continue using that system. If necessary, make the adjustment and purchase the needed software. There's QuickBooks out there as well. That's a good system to purchase. The benefits of software are the reports you can utilize to show you at a moment's notice how well things are going. You can also select an accountant to help you sort out financials. If you think you will need to hire a CPA, make sure it is someone who is willing to explain exactly what they're doing and why they are doing it. Ask them about their fee structure well before they do any work for you. And make sure it's somebody you're comfortable working with as well. That's really important. Have a good relationship with them. Okay, so we've talked about hiring people, we talked about operations, and that was all in the third section of your business plan. Now we're on to the fourth major section of your plan, and that's your financials. It's your financial section. The financial section is where, financial plan is where you show various financial reports to support your idea to continue with your business planning efforts. It contains reports in the format of spreadsheets, graphs, financial statements, and any other method necessary to prove your business should be or is viable by showing projections or actuals as it pertains to revenues and expenses. The first report listed is called Sources and Uses of Funds or Cash. This is where you will list where your money comes from or is coming from to fund your business, how much it is, and what it will be used for. Investors and bankers look at this section closely, so please provide complete details here. Some possible sources of funds might be personal savings, SBA loans, venture capitalists, private or angel investors, even crowdfunding sources. You will simply list the source and then the respective amount with it. The same format is true when you're listing your uses of funds. Simply list what you will be spending the money on and how much you will spend for each expense item. So here, of course, listed written deposit, utilities and deposit, business licenses, business permits, initial inventory, all that kind of stuff. You want to list, give details, and then like next to written deposits, you put how much you're actually using for written deposit, how much you're using for utilities and deposit, how much you're applying for business licenses, etc. The next report is your sales forecast. This report is typically presented as an Excel spreadsheet and shows 12 or 18 months of projections of what you expect to sell, broken down in categories by unit and price points. Your sales forecast is simply a forecast, which is your best educated guess of what you think will really happen during that time. Because your enthusiasm for your idea might cause you to be overly optimistic about your best guess, it's usually a best practice to present your worst case scenario as opposed to your best case scenario. Reason being, seeing a forecast showing really high numbers might cause you to overspend and buy more inventory, for example, than you might end up really needing. You would much rather buy less than you sell and have to buy more later than to buy more than you ever have a chance of ever selling and have no chance and have to take a loss for that and dump it all at below market prices. Okay, so again, you want to give your best educated guess, but you want to err on the side of low versus high when you're making that guess. The sales dollars per month are determined by the number of units sold in a month multiplied by the price at which you will sell those units. When trying to determine a goal for your sales per month, think about how many customers per day you would need to see, spending how much money per visit to come up with this number. Once you reach that number, use that same logic for the rest of the month per category. And the categories are dealing with every type of item that you're selling, okay? Per price point for the entire month. Once you arrive at that number, multiply that by 12 whole months to get an idea of your potential sales for the year. Again, sales per month is determined by the number of units that you plan to sell or will sell or have sold, multiplied by the price per unit. For example, $200 in sales is a result of selling 10 scarves at $20 per scarf. Now, the thing about sales is that they're cyclical. They fluctuate or go up and down depending on what is going on, depending on the competition, depending on how many days you'll be open, and depending on lots of things, actually. Also take into consideration when figuring out your projections how much each customer might spend each time they visit and how many times they might return and make yet another purchase. Once you come up with a goal number to strive for, think about how many customers would it take, spending what amount of money would reach that number. Then ask yourself if that is a realistic number for you to reach, especially if you're a solopreneur. If you're the only one doing the sales, if you're the only one doing the marketing, the only one doing everything, purchasing inventory, et cetera, then think about what is truly realistic for you to achieve in an 8-hour day, 5 days a week. And when thinking about a unit, think about what in your business will sell and in what increment will that item be sold. If I'm a bakery, my unit could be donuts, it could be muffins, it could be cookies, it could be pies, or it could be cakes. If I'm a daycare, my unit is children, broken down into age ranges based on price levels, right? One unit might be infants up to 6 months. One unit might be newborns. Another unit might be 7 months old to 18 months. Breaking your units down by price categories keeps it manageable and helps it make more sense. If I'm a service business, my unit might be broken down by hours of service and shown as my hourly rate for the service I'm providing. If there are several types of service, I might categorize them by the price charged for that particular service or break it down by the type of service I'm providing. For example, if I'm a seamstress or a tailor, I might list hemming pants as a category or a unit. Alterations might be yet another category or unit. And then I'll put in the sale price of those hemming or the sale price of the alterations. And then I would add down my categories. So the sheet that you see now is what a sales forecast could look like. And as you see, it has the months at the very top of it. And on the far left corner, far left side, you have categories 1, category 2, category 3. And then you have sales price at unit, and then you have category 1 total. So again, it's all based on what you're selling, the category of what the item is, and then what the price is, and then what that is when you multiply that times that. All righty. So on to the cash flow statement. The next report is shown as the cash flow statement. Your cash flow statement is presented as a spreadsheet as well, and it feeds off the numbers you projected monthly in your sales forecast. The definition is the pattern of income and expenditures, and that come and go into a business, come and go in and out of a business. Looking at cash receipts or net income. Okay, this is what a cash flow sheet would look like. It shows the patterns of income and expenses coming in and going out of your business. Showing a large amount of cash at the end of a period is not the same as showing a huge profit at the end of that same period. It simply shows how much cash is flowing in and out of the business. The first category listed is cash on hand, and that's been a beginning of month. This number reflects the amount of cash left from the prior month. Next, the sheet shows the months, which is at the top of the page there, starting at January and ending at December if I'm showing 12 months of projections. After that, there's a total column where it then summarizes per category projections for that entire period. For the section called cash receipts, the first category listed is cash sales or sales. That number comes from the number you showed in your sales forecast and will reflect each month's total for all the categories. So I'm gonna flip back, I think, to the forecast. So down here, this cash flow forecast, so sales right here for January should equal the same number, the same amount that you had on your, go back to slides, right? January total here. I'm sorry, monthly totals here. So when you get up all your categories right here, this is the amount that you're going to show on your cash flow forecast. Okay, which would be right here for sales. So January sales right here will reflect what was in your monthly category, all total in your your sales forecast. That was kind of crazy, right? Okay, so that number comes from the number you show in your sales forecast and reflect each month's total for all of your categories. After that, you will see something called receivables, which will indicate what people owe you, what your customers possibly owe you. And that you'll do that based, it's not as much used as it used to be with people buying on credit. So only if you like doing business to business where you are doing invoicing, that's when you would add in that amount there. Next, you would show any money you get from savings, and you would possibly use that at startup. Following that, you would then list any other source of cash. You know, if you're getting loans or something like that, then that's when you put that there. And then you would total up all the cash receipts that you have, and that will be in your total cash receipts area. So following the total cash receipts is a category called cash paid out. And that in that section is where you list all the things you're going to spend cash on. At the end of the month, you will subtract that amount from the cash paid out. I'm sorry, you will subtract the cash paid out from your cash receipts, and then that will give you your cash position at the end of the month. If this number is negative, you need to go back, especially doing projections. Shouldn't be negative when you're doing projections. You should not project a negative number. But if you're doing all you're putting in, you know, or your cash is coming in, and then you put in your cash is paid out, and at the end of that, your position is negative, then go back and revisit your cash paid out to figure out what is it I can do without. You know, in my planning process, you know, maybe I don't need to have an additional this or that, you know, and maybe inventory is too large. Maybe I can reduce that amount. So that's what you need to think about at that point. However, if you are in business already, then one thing you can consider is what can I buy, what can I spend, what can I buy with credit, you know? And then when you're thinking about buying with credit, you want to make sure that what you decide to buy with credit is something that you truly need to have. Otherwise, I'd say don't buy on credit, okay? Again, only you have to do some analysis there to figure out what do I really need to keep my business going. Other options, of course, would be to slow down your spending, right? You never want to totally deplete your cash. You always want to set aside some cash for a rainy day or for an emergency. You never know what could come up where you need to put your hands on some cash right away. Here are some tips for preparing your cash flow statement. My screen is back. Here are some tips for preparing your cash flow statement. Determine if and when you will have a seasonal fluctuation. Determine when and how you plan to advertise. Determine your company's sales payment policies. Determine your pricing. And be sure to include any owner's draws. And just so you know, owner's draw is not the same as an owner's salary. It's more like a one-time bonus and should be recorded each time a draw is taken. Start with the paid out section first, and then write down any assumptions that you might have in preparing for your cash flow. Always consider what your competition charges when determining your pricing, and you want to remain competitive. You also want to make sure that you cover your costs. Okay, let's see if I can get this little guide to go away again. Okay. There was a way that did it before. I can't figure out what that was. Okay. All right, I'll keep going on. Hopefully you all can see this. Okay. Sorry about that. The next report we will look at is called a balance sheet. A balance sheet is a financial statement that summarizes a company's assets, liabilities, and owner's equity. It tells what the company owns and owes, as well as the amount invested by the owner or the shareholders. So a balance sheet shows a snapshot in time. Okay, so think of that as a snapshot in time. This is what my company is worth as of this point and this time. And people use the balance sheet a lot if they're about to sell their business, or they're trying to show their stockholders or convince their stockholders that, hey, this business is profitable. Check this out. Look at my balance sheet. It tells them the net worth. Okay, so that's the reason that people use a balance sheet and why that's necessary. Again, if you're about to sell your company, this lets your investor know, the person who is intending to buy it, what your business is worth. Okay, this measures and shows your net worth. So a balance sheet starts off with the name balance sheet at the top of it. If this thing doesn't show the top, but it shows it there. And it's always followed by the date that the information was gathered. To compile this data, you will need to look at inventory totals. You need to look at equipment totals, your books to get numbers, census report list, everything the business owns and owes. Then it is placed in categories based on whether or not it is an asset, something of value that the business owns, or maybe it's a liability or debt, something the business owes. The assets are listed on the left side of the page, which is listed here. I'm going to try my best to get this thing off of here. I tried everything else, right? Just security. Let's see, choose local background. Okay. Floating thing. Okay. All right, here you go. It's a floating screen thing. All right, so I'm starting again. A balance sheet starts off with the name balance sheet, and it's listed there, and it's also followed by a date. Okay. To compile this data, you will look at inventory totals, equipment totals. You look at your books to get the numbers, since this report lists everything the business owns and the business owes. Then you place it into a category based on whether it's an asset or whether it's a debt. Okay. With the assets listed on the left, and they're broken down by whether they're current assets, and that's something that's liquid. You can make it liquid within 12 months, which means converted to cash, right? Or it's also to fixed assets, which are things that you have to try a little harder to liquidate, basically, to make into cash. Again, this is a sheet that you use to determine A, if there's going to be a fire sale and you have to get rid of everything right away, or B, someone is interested in buying your business and they want to know what is your net worth. So that's the purpose of putting these things out there, okay? And then the liabilities are things which you owe, those listed on the right-hand side of the page, starting with current liabilities. Again, current meaning within that they're due within 12 months, and long-term meaning they're due beyond that 12-month period. So once you've come up with your total, with the total of all of your assets, so you're going to add together your current assets plus your fixed assets, and that will give you your total assets right down here. Then you do the same thing with your liabilities. You list the current ones, then you'll total the current ones. You list the long-term ones, and you'll total the long-term ones. And then you'll add the current plus the long-term to get your total liabilities. And then at that point, the balance part comes in, you look at your total liabilities and your total assets, you compare those numbers there, okay? And then at that point, you're gonna subtract your total liabilities from your total assets. So think about this equation. Total assets minus total liabilities equals owner's equity and net worth, okay? So total assets minus total liabilities equals owner's equity and net worth. So if your total assets are larger than your total liabilities, that means that your net worth and your net worth and owner's equity are going to be a positive number, which is good. Okay, that's your goal. That your goal is to have that number larger than your assets larger than your liabilities, because again, that means you have an increased net worth, and that's a good thing. Okay, that's what you're shopping for. Because then at that point, you are more appealing to a potential buyer. Because a potential buyer will say, this business has a good net worth, okay, a positive net worth. They're looking again at everything that you own versus what you owe, and they're not buying a lot of debt. Okay, that's what they're looking at, okay? Next is the income statement, or some people call it the profit and loss statement. This is a report that looks a whole lot like the cash flow statement with a few exceptions, which is why this report measures a company's profitability, okay? But the cash flow measures the company's cash. So here the definition says, this is a financial report that by summarizing the revenues and expenses and showing the net profit or net loss in a specified accounting period, this one depicts a business entity's financial performance, okay? Again, this talks about, are they performing well or not? Are they showing a profit or are they showing a loss? And that's what they're talking about with performance, the word performance. So again, the income statement summarizes the revenues and expenses to show a company's net profit or net loss in a specified time period. It considers the cost of making or purchasing a product, okay, and that's called cost of goods sold, and then it subtracts that from sales to show what is left over to take care of the operations expenses, okay? So this category is called cost of goods sold or cost of sales, and what's left after that happens is gross margin or gross loss if it's a negative number. And the reason that would be a negative number is that it means that it's costing you too much to produce or costing you too much to purchase that product that you're trying to sell. You're selling it for a number that's way lower than it costs you to get it or produce it, okay? So that's when you have to go back to the drawing board and say, okay, where can I purchase this item for a lot less? Or how can I make this item for a lot less? Or maybe I need to consider raising my prices, okay, selling it at a higher price in order for you to observe a better gross margin. If a company is profitable, once cost of goods sold is subtracted out, they will have enough money left over to take care of their operating expenses. If a company is not profitable, they will show a negative number and that will be called a gross loss. And like I just explained before, if you have a negative number, you need to reevaluate what you're doing and how you're doing it. You need to purchase or make your product a lot cheaper than what you're selling it at. So now you know enough about finances to be dangerous or perhaps have a huge headache, one or the other, okay? So next we're going to talk about keeping your business legal, starting with deciding on a legal business structure. When deciding on which structure to form, think about the likelihood of someone becoming injured or harmed while doing business with you. If injury or harm is very likely, you want to consider an LLC or an S Corp or C Corp, as these will legally separate your business assets so that if someone sues your business, they're not able to automatically tap your personal assets. Okay, if you look at this line right here, liability protection, a sole proprietor, it says no. So you don't have any protection as a sole proprietor. As a partnership, no. As a C corporation, as S corporation, or an LLC, it says liability protection, yes, okay? So again, if there's a likelihood of someone becoming injured or harmed doing business with you, you want to make sure that you have liability protection. Also too, another thing to think about is member restrictions. So sole proprietor, yes, you must have one person. One person is a sole proprietor, so that's the restriction there. There is no restriction for partnerships or C corporations. There is, however, member restrictions for S corporations, but none for the LLC. And of course, there's issues of double taxation, and that you see that with the C corporation, S corporation, and LLC. Because basically, as LLC, which is the very common choice, you will file your Schedule C. So you'll do that on your personal tax return. So there is your double taxation there. Okay, so next you want to choose your business name. When choosing your business name, choose a name that's short and descriptive, easy to remember, unique, okay? And one that's, again, the one that makes sense, okay? We'll make sure it makes sense. Once you've chosen your name, once you've chosen a name you want to use, you'll need to check to see if that name is available to be used. I'm gonna go back a couple of slides. Okay, so to check this, you'll access the Secretary of State's website, and that's www.sos.ky.gov. You'll do a business name search. You'll key in the name you wish to use. If it comes back with that information on that name, that means that somebody else has that name. So in that case, you need to choose another name and search again. Okay, once you do the search again on the name, the new name that you've chosen, if that comes back and says no records found, then that name is available for you to use. When you're truly ready to start your business, you need to register your business with the state of Kentucky, okay? You do that through the Secretary of State's one-stop business portal. And that's http://one-stop, onestop.ky.gov. You also need to register with your local county clerk's office to obtain a local business license, which is also called an occupational license. You'll need to get an EIN number if you haven't already done so. And when you go to that one-stop business portal, you'll be prompted once you register with the state to actually go off of that site and get your EIN number. You'll also be prompted to go to your local county clerk's office to do your local licensing as well. So they've set it up pretty good so that it kind of gets you from one thing to the other without going, without taking lots of cumbersome steps, which is good. Another thing you'll need to do is apply for your certificate of occupancy if you'll be working from home. This grants you permission to use your personal residence for your business and will be granted or not based on your local zoning laws. So depending on how your neighborhood is zoned, you may or may not be able to set up a business in your home, business office in your home. And my favorite example of that is a show called Bewitched that had a character, Gladys Kravitz, and she always hung out the window and looked out the window to see what's going on. So all you need is have is people come and go into your house to conduct business, and Gladys is at their window looking at you, wondering, oh my God, look at all those people coming. And of course, she's going to assume the worst. She's going to assume that you're trafficking drugs or something and call the police. So as long as you have your certificate of occupancy, you're good. Okay. So just saying that everybody has a neighbor that's Gladys Kravitz looking out the window. Okay. All righty, so we'll go on ahead. Okay, so basically now you're ready once you do all those steps to start your business and start making money. That's good, right? So what does it take to succeed? Okay, there are definite pros of business ownership. You'll be the boss and you get to make the decisions that are critical to your success or failure, by the way, okay? You have the personal satisfaction of creating and running a successful business. And that's always a good thing. And you'll also have the potential, okay, to earn more money than you could as an employee. Again, that potential is defined by you and how much effort and energy you put into it. There are also some cons to business ownership, such as you'll have to personally bear the burden and financial risk of starting your own business. That's definitely not a good thing, right? You'll most likely work longer hours and have less time for vacations. So again, do something that you enjoy doing, where it doesn't matter how much time you put into it, it's okay, think about that. At first, your income may be smaller, okay, and less steady. But again, that depends on you and how much energy and effort you put into it. You have to do it all unless you decide you need to hire employees. And if you get to that point, please hire someone. I've run into so many, especially women, who think they can do everything without hiring anybody. And these are women who have successful businesses and they're making money, but they have chosen not to make a hiring decision. So I say, we can't do it all. We can do a lot of things, but we can't do it all. So please hire somebody if you need help. As a business owner, you'll have several roles, but you know that. You wear many hats. You'll be a tax collector. You'll be the accountant. You'll be the lawyer. You'll be market researcher. And again, like we said with your SWOT analysis, we kind of pointed out your strengths and weaknesses by saying, oh, those things that you're weakest at, get somebody to help you to make that become a strength. Okay? So basically, you have that power to make that hiring decision. And so do that. Make that choice. Hire somebody to help you. Now, a business owner has several personality traits, and a successful one has these personality traits, such as a self-starter, okay? The willingness to sacrifice. They have strong interpersonal and communication skills, strong leadership skills. They follow through. Once they say, I'm going to do this, or I'm going to make that call or follow up with that customer, they actually do that, okay? That's what these are personality traits of a successful business owner. A good manager of money and finances. You have to kind of, realize, okay, I need to get my finances in order. I need to take care of these things. So you methodically take those necessary steps to do that. And also, a successful business owner is one who's able to resolve problems quickly and creatively, okay? They also don't lead with emotion and fly off the handle. So you kind of have to keep everything in check. It's so easy to just go berserk, but, we have to not do that, right? So basically, starting a business is actually easy. You can get business cards printed up from Staples or any place else. You get a business address at the post office. But starting a business is one. A successful business owner is one who comes in with education, with careful planning, and adequate cash flow. Okay, and also too, I've seen a lot of businesses fail because they don't have enough cash flow. That is so important to figure out what you need and try to get, have a little bit more than what you need. Have some, set aside for those emergencies because they will come up, okay? So success in business comes from education, careful planning, and adequate cash flow. And you must understand the industry and the market you are entering, okay? So again, that your business comes from this idea that you have, or maybe some friends or whatever told you things that they're missing, and they just feel like, okay, somebody needs to start a business to take care of that, okay? Then you want to put together your business plan, but first you want to make sure that there's a need for it, right? Is there a need for it? Does it make sense? What problem am I solving? What skills and knowledge do I bring to this idea? How will it be funded? All that kind of good stuff. So you have to kind of put all that together. Make sure you're able to describe and define the product or service that you're going to offer. And again, what customer problem or challenge does it solve? Okay, that's so important. And, is it something that makes sense in today's world? Is it something that's feasible? Does it make, again, can it be done? Should it be done? All that stuff. So some famous parting words are never trust anyone else to care about your money more than you do, okay? And I know we talked about the financials, we kind of ran through that. And we also talked about accountants too, and CPAs. So you definitely want to make sure you have a good understanding of your financials, a good understanding of how to put that together and what the categories mean. Make sure you know how to just plan it out and observe the fact that, okay, if I'm paying too much for this, then I need to think about how can I decrease that cost? How can I make it cost less? Okay, so at this point, hopefully you've used the chat box and you're ready to, Elaine is ready to give me the questions that are in the chat box. Elaine, are you there?
I did remember to unmute. Yes, I have one question.
Okay, good.
How will people be able to access the recorded versions of these presentations?
That is a very good question. And Monica, my marketing guru, possibly can answer that question. We're going to put them on our website. That's I know that's eventual. I'll jump in there, Monica. Our plan is to put them on our website so that they are accessible for later. So the website again is www.wbckentucky.org. So spell out Kentucky, wbckentucky.org. Okay.
All right, here's another question.
Uh-huh.